Welcome to another episode of Market Money. Today we're going to be covering Economics 101 for the investor. Now, I wanted to do this topic because, especially in this climate that we're in right now, a lot of conversations about interest rates and the economy and GDP. I thought it'd be a good idea to get somebody who is a subject matter expert in the field to come give us the basics of economics and just explain certain concepts, go over maybe some scenarios to help us as investors just understand what we hear as it relates to those things. So it's going to be an episode focused on the financial education piece. As you know, for Market Money, we do stock reviews, financial education, or guest interviews. So no interviews for today, no stock reviews for today, though I have seen quite a number of reports come out just now on our news feed. So let me know in the chat though which company you may want us to review. But for now, I wanted to focus and wrap your mind around any economics questions that you may have. And we'll have our guest join us just in a second. Let me just run this intro and then we get started. All right. So with me is our special guest, Keenan Faulkner. Keenan, welcome. Thank you for joining us.
Hey, thanks so much for having me, Jermaine. It's good to be here. And good evening to all of your listeners, your viewers.
Thank you so much. I'm so happy when I asked you, you said yes, and we're able to make this happen. So I'll ask you just to introduce yourself for a little bit, what you do, your experience maybe in dealing with this topic, just so that our users, our audience understands your background.
Right. So, I'm Keenan Faulkner and I'm an economist by profession and by training. I have been an economist in the civil service for about 5 to 6 years now. Well, more than 6 years. My work has spanned across the Ministry of Finance, Bank of Jamaica, the IMF, the Development Bank of Jamaica, as well as the UN. I've also independently been an author of several peer-reviewed journal articles and book chapters as well, dealing with different aspects of the economy, mostly institutional and fiscal economics. And my primary interest really lies in the fiscal side of economics, but economics in general. It's something I like to talk about and discuss and have these kinds of different fora and conversations pertaining to financial literacy and so on.
All right, perfect. Which means you're the best person to be having this conversation with us, right?
I hope.
All right, so you do have some slides to share. So the format that we're going to go with is Keenan has a brief presentation. We'll do the presentation and then we'll have general Q&A. So we're going to ask some very targeted questions, but first he'll lay the foundation by explaining some concepts. Then we'll have our standard Q&A. And so if you have any questions as we go through, just post them in the chat and we'll take all of them at the end. All right. So over to you, Keenan. Once you share, I will then. So remember to go to full screen and then over to you.
All right. So everybody should be seeing this, right?
Yes, we are seeing it.
All right, great. So talking about economics for investing, really making investment decisions. It's not the kind of session where we're talking about different stocks and those more firm level microeconomic considerations specific to investment decisions. This is now dealing with the macro economy, the things that you hear about in the news every single day. Demand and supply, the firm, different market structures depending on the industry that different firms are in, aggregate output, prices, economic growth. We hear all of those things coming on the news every single day. But what does it mean for making investment decisions, or how should we think about these things. And I just want to, for it to be conversational. I know we have questions and answers at the end, but I don't want it to be so rigid. I want to kind of give some examples of things that happened a couple of years ago, right? Somebody in the investor community had messaged me. I'd made a post on Twitter about oil, and the fact that we import so much oil every year. We pay so much US, tens of millions of US dollars per year. It's our largest import, our biggest spend of foreign exchange, and they were looking to invest in a company that dealt with oil and gas. And persons can probably figure out what that company is on the stock market. No, and the post that I did, it said that at the time, this was around 15 years ago, 87% of what of the imports that are oil, the value of the imports would have been oil, something like that. And they were looking to invest. So that was something, a statistic that meant something to them, right? Who are trying to make investment decisions, because they're trying to say, okay, if we're so heavily dependent on this, then it makes sense to invest in this. We look at the fact that so many cars, we have well over 600,000 vehicles now on the roads, and they all have to use gas. They all have to go and fill up at the tank. So clearly that stock might have been expected to do very well. Or you even think about the stock related to toll roads, for example. There's going to be more vehicles, more usage, should be more profit, things like that. So that is how the investor thinks, by looking at those sort of macroeconomic stuff. If they weren't paying attention to imports and exports, they might not have seen an opportunity right there. So things like understanding business cycles, monetary and fiscal policy, from the government standpoint, Ministry of Finance, the Bank of Jamaica, I've had the opportunity to work with both. So I can say how much, to what extent, in what way does that affect investing decisions, international trade and capital flows, currency and exchange rates, economic growth and investment decisions, and market regulations. To what extent are the market regulations tight? Are they very accommodating? Those things all affect investment decisions in some way or another. So as much as Jermaine has tried to say that it is very brief, I've tried to make it very brief, but also it's very wide without being too deep. We don't want to get into the nitty gritty of, IS and LM curves and X and Y and all of those things. That's not something we need to know right now. We just need to see how can we interpret the things that we see going on in the economy. So basic demand and supply is the first one. Demand represents buyer's behavior, supply represents the seller's behavior. In every single market, you have demand. It's governed by demand and supply in an unfettered manner for the most part, depending on the level of government intervention. Everything that you expect to invest in, whether it be real estate, whether it be the equities market, whether it be the bond market, they're all governed by demand and supply, and the aggregate demand and supply comes together to produce the price at equilibrium, where the highest price is willingly paid by buyers is just equal to the lowest price that's willingly accepted by sellers. So whenever all of those things come together, we know our demand curve slopes downward from upper right to lower left, upward left to lower right. Supply goes the other way, and wherever that intersects is you find your equilibrium price. But that in real terms is never always the case. You have so many things that impact upon demand and supply, and that's assuming that the market is perfect. That information freely flows from one person to the other. Everybody has the same sort of information. That's not always the case in reality. Some people tend to have an advantage where that's concerned. It does affect the demand, does affect the supply. You have also the idea of demand being artificial. It could be that we demand something, in theory, we all want something, but demand is the point at which, you want it and you're able to pay that price for it. So it's not just, I see something for $10 and I want it, and that counts as demand. Now I have to be able and willing to pay that $10 for the product. Supply, you know, is dependent on so many other factors. If you're in the business of production, maybe you increase your technology and you can increase your supply. If you're also thinking about, you know, you have spent more money on investing to increase your supply as well, and then you can charge higher prices for whatever it is that you're producing. So, goods markets are the interactions of consumers as buyers, firms as sellers of goods produced by firms, bought by households. You have the three main economic agents: firm, household, and government. So the factor markets, interaction of demand and supply, are the interactions of firms as buyers and households as sellers of land, labor, capital, and entrepreneurial risk taking. Those are considered the factors of production, And it was a quote, not really a quote, but an idea that I came across, that you're not really truly wealthy if you don't own and operate or control at least one or more of the factors of production. So land, labor, capital, you have to own one of those, that can produce in perpetuity if you want to be able to generate and garner real wealth, as opposed to just, merely making money in the short term. So capital markets, they're used by firms to sell debt or equity to raise long-term capital to finance the production of goods and services. Like any other market, there is a demand for that debt or equity. There's a supply of that debt or equity that's willing to be supplied by the people who control capital. Every single market you can think of still operates on this very basic premise. The prices that you see, assuming that it is a free market and it is relatively unfettered in its operation, the invisible hand, free hand that operates it, they will determine a price, on that level playing field. If at a given price, the quantity it doesn't always equilibrate at the point that you want it to. So sometimes the quantity demanded exceeds the quantity supplied. So if you have more demand than supply, then the price will tend to rise, in order to equilibrate those two things. And of course, the reverse is also true. If the quantity supplied exceeds the quantity demanded, there's excess supply, and the price will, of course, tend to fall in order to equilibrate that. So in terms of firms and market structures, we think about perfect competition, we think about monopolies, we think about oligopolies and, monopolistic competition. So they are distinct in their nature. There are some others that are, less popular, like monopsony, where, you just have one, you're a big company, you're selling just to one person kind of thing. And then there are a few others, but these are the four main types, right? So if you want to be a good financial analyst, you have to understand the characteristics of those market structures to better forecast a firm's future profit stream. Remember, different firms operate in different environments. It's not the same for persons who operate in perfect competition or for those that operate a monopoly. And in terms of predicting and forecasting what might be the economic situation, my decisions to invest are going to be naturally very different because they're premised on different things. So in terms of the number of producers, you can tell just by the name, there are many in perfect and monopolistic competition, few in oligopoly. You have just one and two persons that are controlling the market. A duopoly is an example of an oligopoly, like telecommunications, for example. Monopoly would be, many public services, public utilities tend to be monopolies. The degree of product differentiation and pricing power differs from market to market. You have barriers to entry of new producers, and the level of non-price competition for all of those are very low. So in perfect competition, everybody is basically on the same page. They're not individually big enough to influence the rest of the market by themselves. They basically have to take whatever price is given, right? it's moderate in somewhat monopolistic competition. It's very high in oligopoly, and it's generally the highest in monopoly. In monopoly, you can basically control everything that you want. But the degree to which each of these can be classified as, um, you know, or attributed rather to the different types of markets and firms out there really depends on perception, because you could be a monopoly, you could think you're a monopolist, and in truth, you are really in monopolistic competition with somebody else, right? You could think that you are in a duopoly, but uh, you know, it's not quite a true oligopoly, duopolistic relationship. So it really does depend on the level of market share. And of course, sometimes it's very hard as an investor maybe to make certain decisions, because some things are not put out there on the basis that they are market sensitive. You don't always see that this information is there for good reason as well. Nobody wants this information to be out there. Some persons might have it, some persons don't have it. But um, when we talk about market sensitivity, you tend to see those things coming up. So in terms of the quantity sold, it's normally the highest in perfect competition, because everybody is trying to outdo each other and undercut everybody else. So they can all lower the prices and sell as much as they want. Price in perfect competition is usually the lowest. As I said, monopolists, oligopolists, and people in monopolistic competition tend to differentiate their products so that they can charge higher prices. So typically monopolists sell at a smaller quantity and a higher price. They want to kind of keep it artificially lower so that they can charge higher, because nobody is competing with them so that they can, do whatever they want, right? Depending on subject to market regulations and market forces and so on. Investors will probably benefit from being shareholders in a monopolistic firm that have very large margins and substantial positive cash flows, depending. So competitive firms don't tend to make an economic profit, even if they do make an accounting profit, which is a different concept altogether. There will be market compensation for like renting capital and management services, but the lack of pricing power means that there's no extra margin. They can't price out of the market basically if they're in perfect competition, because people will always just switch to a different competitor. So aggregate output prices, economic growth. Yeah, GDP enables us to really assign a monetary value to the economy's level of output. It's really just the value of the economy today, in this year, vis-a-vis what it was one period ago or the year ago. Aggregate demand and aggregate supply determines the level of GDP as well as the general level of prices. So if you want long-term sustainable growth of the economy, it depends on the growth in supply and the growth of input. So labor, capital, natural resources, the factors of production, as well as increases in technology. So in order for a country to really grow its GDP, we kind of, in the Jamaican case at least, many developing countries, just like Jamaica, we don't really have much change in our structure in terms of the industries. For a long time, we have said that we have had to we should update our industrial policy, our productivity policy, our investment policy, those things, our labor market policy as well. And, we have the same traditional industries that are expected to give us this output every single year, and growth is of the order of 1 to 2% every single year. That's not the sign of an economy that's transitioning to higher value goods and services and outputs. So because we don't have the capacity that is related to the inputs, right? The inputs also include things like education. It also includes, the environment in which to set up businesses, things like the high cost of energy and so on, right? And so we can't supply the things that are needed in order to get us from one stage to the other. So if you're looking at something like economic growth, yes, in as much as you can use that to make investment decisions, you're really looking at the stability of growth, the certainty of growth. We have grown for 12 quarters in a row now, which is only second to the 19 quarters leading up to COVID. So if you're looking at growth, you expect it to be 1 to 2%. You don't expect it to be 5, 6, 7, 8, 9, 10% that will take you to the next level, right? And you just hope that it doesn't become negative. You're not looking to make investment decisions on the basis that I expect growth to be 5%. It's not something that's going to happen in a Jamaican context for quite some time. But from an investment perspective, analyzing those macroeconomic variables and forecasting is important because business profits, valuating assets, interest rates, inflation rates, they all depend on the business cycle, in the short to intermediate term, on the drivers of sustainable economic growth in the long term. So, yes, everything is premised on economic growth. Even in fiscal, some of the revenues that you expect to be realized is dependent on growth. If you're not going to grow as high this year as you are in the year before, then revenues might come in less. The same thing probably will apply to individual firms, for example. But that's just one component. It's not be all and end all that determines what profits might be overall. So businesses produce most of the economy's output and income and invest to maintain and expand productive capacity. Companies might retain some earnings but pay out most of their revenue as income to the household sector and as taxes to the government. And all of those earnings, those are all dependent on macroeconomic conditions. Sometimes you have firms, they might defy what happens in the wider sector, the wider economy, and the wider industry. And they keep growing, and then, or vice versa, the economy might be growing, but you have this firm that is doing poorly for one reason or another. So it's not always a case where a rising tide will tend to lift all boats, because everybody has different circumstances that are peculiar, very specific to their own management, operational decisions. So the government sector collects taxes from households and businesses, purchases goods and services from the private business sector. And that's how the money keeps churning, and velocity of money continues to switch between hands. Capital markets provide a link between savings and investment in the economy. The more people save, the more they say that you tend to invest. So there's a larger pool of investable money, that other persons can take advantage of. And that brings me to the business cycle. So the business cycle has 4 phases. The trough, which is really at the bottom. Expansion, you find that it continues to go up and up. Peak when it reaches the top, and then contraction, it starts to go back down. It's going to look like a bell kind of shape. The demand for factors of production might change in the short run as a result of all changes in the components of GDP. So, consumption, investment, government spending, and net exports. So consumption, meaning households worry about the future, they save more and they shift aggregate demand to the left. Investment, as we said, companies expect customers to increase demand, so they buy new equipment, thus shifting aggregate demand to the right. And that's how consumption and investment fluctuate with business cycles and decisions made in the business cycles. Another example is that companies introduce new technologies, they shift the long-term aggregate supply to the right. Government, with their fiscal and monetary policies, can shift aggregate demand any which way. It can be expansionary or it can be contractionary. I'll get to that later down. Net exports, faster growth in other countries generates higher demand for the home country's products, thus shifting aggregate demand to the right, or higher prices of imported inputs shift aggregate supply to the left. So any shifts, to use those examples just to say, any shifts in aggregate demand or aggregate supply really affects demand for the factors of production. So it will affect demand for capital, it affects the demand for labor that are used to produce the new level of GDP in the economy. And that's how business cycles, they shift, they go from boom to bust and vice versa and back and forth and what have you. And as part of the business cycle, that also affects employment. Now, recently, statin has changed how it measures employment, measures unemployment. But so it went back up to 5.2. It's not comparable to previous, iterations of the labor market survey, but that's just to say, those things have to be borne in mind even when you're wanting to make investment decisions. Who is classified as employed and unemployed, right? So it has different categories. There are frictional people; those are not working because they're between jobs. When we look at the unemployment rate, most of those persons are frictional. I think it's around 80,000 people. That constitutes the 5%. The other 1.4 million persons who are working are persons who are looking, they're in jobs. These are persons who are looking, they're not in a job right now, but they're in the labor force. So those persons are just, moving between jobs, right? I resign my job and I want to move to a higher paying job, but for a couple months or weeks, maybe I might be unemployed just for the period of the reference week. Structural are persons who are unemployed because they don't have the skills. That's such a problem that we're faced with now. We're talking about things like importing labor. We're talking about how can we upskill persons to take on the new demands of the labor market, like we discussed with demand and supply. Those are things that are so crucial, and it affects some industries more than others, like construction, for example. They need people, but they can't get people to complement the boom in real estate that has been happening. All of these things affect investment decisions, watching how the market operates and the things that influence different parts of the market. So that's a big problem in the Jamaican context. It is said that we have about 15% of the labor force does not have, or 15% rather, has some form of tertiary qualification. That could be a degree, a certificate, or a diploma. Even fewer persons, therefore, would have a degree if you're aggregating that as persons in just tertiary qualified. So you have persons who are discouraged workers, they're unemployed people, they've given up looking for jobs because they don't believe they can find one. Those persons are outside the labor force completely because they are not looking for jobs. Voluntarily employed people, they don't wish to work, because they're in school, they've retired early, or they're very rich. Those persons are also outside of the labor force. So price levels are affected by real factors and monetary factors. Real factors include aggregate supply. An increase in supply leads to lower prices, and aggregate demand. An increase in demand leads to higher prices. In the Jamaican situation, we have our unemployment rate being around 4 to 5% is below what it is said that our non-accelerating inflation rate of unemployment is. That's around 6 to 7%. There's a relationship in economics that brings together unemployment and inflation. And if your unemployment dips below a certain level, inflation tends to accelerate. So it's, in theory at least, you almost never have low inflation simultaneously with low unemployment. So those are also things that you have to think about, possibly in the entire, schema as it pertains to investing decisions. Monetary factors include supply of money. If more money is circulating and the economy is in equilibrium, will lead to higher prices, and velocity of money, which is the speed with which it changes hands between people who are spending money. If I give you $100, you spend that $100 on somebody else, they spend it buying something else from somebody, and so on. If a higher velocity means that it will lead to higher prices because there is more money circulating at any given time. More money circulating can come from people earning more, from more persons being employed. Monetary and fiscal policy from this side of the government. In brief, monetary policy is central bank, and of course our Bank of Jamaica is independent, which means that the finance minister cannot call the governor of the Bank of Jamaica and say, we want to borrow money, as happened many times in the past. They had to finance the fiscal deficits that were being run. And this, I'd like to talk about this one, especially having been involved in it day to day, because we have an experience in Jamaica where we could not afford to pay our bills, our revenues did not match up to our expenditure. We didn't have enough to pay our debt first, which is what we need to do, and then have enough left over to be able to spend on day-to-day running of the country, plus our capital expenditure. So all of those things do affect investment decisions. It limits the government's capacity themselves to invest, if you're running fiscal deficits. And it also can have a sort of knock-on effect. If the government cannot now afford to pump money into the initiatives that are going to grow the economy, then other firms and private enterprises might not be incentivized to do the same, because there's no stable environment with which to pursue this sort of development imperative. So, fiscal policy refers to government's decisions as just taxes and spending and so on. Monetary policy mostly just relates to interest rates as well as the exchange rate. They want to influence the quantity of money and credit that you can loan to people in the economy. So the wealth that the citizens of an economy choose to hold in the form of money, as opposed to, say, bonds and equities, is known as the demand for money. You have different demands for money, like M1, M2, and all of those things. There are three basic motives for holding money. To conduct transactions. It's precautionary because you just need money in case of anything, and it's speculative. People kind of hold on to it for speculative reasons, just like any other kind of asset, really. So we're talking about interest rates. Jermaine mentioned it earlier. Nominal rate of interest has three components: has a real required rate of return, a component to compensate lenders for future inflation, and a risk premium to compensate lenders for uncertainty, about the future rate of inflation. You wouldn't lend money to somebody expecting to get back the same amount of money tomorrow, because a dollar today is worth more than a dollar tomorrow. So interest rates equalize the value between the present value and the future value of money. So by setting its policy rate, which is the overnight rate that for commercial banks holding deposits at the Bank of Jamaica, the central bank hopes to influence the real economy via the policy rate's impact on other market interest rates. So from an investment standpoint, interest rates have been raised to a level that has not been seen in Jamaica for a long time. And that has had knock-on effects on, of course, the real economy and investing in different asset classes and anything that you have to borrow money. It affects companies' ability to expand. It, of course, filters into their stock prices, and that invariably affects people's investment decisions. And the motive for doing that was to bring down inflation. In the 90s, they called it mopping up excess liquidity. Things are different, a little bit different back then, but the main point is that by raising the policy rate, banks are expected to fall in line. The central bank governor had been making the point that the interest rate on deposits, was not following interest rate on loans. So the interest rates are higher, but you're not getting enough money, on your deposits, as opposed to paying no more for loans. So all of those things, affect people's investment decisions as well. But in the Jamaican context, and it's just something that is not really convenient, from an investor standpoint, where prices are sticky downwards. So they are easy to go up, but they're not easy to come back down. So if we do lower interest rates, no, it's still going to take a while, maybe another, I don't want to estimate or speculate, but it's going to take some time for that to be reflected in the market. So you raise interest rates almost immediately and to unprecedented levels, but you're going to take a while now to carry them back down and maybe give persons some relief. That's sticky price adjustment downwards. It always happens. Prices go up very easily. Prices go down very hard. So the challenge for central banks as they try to manipulate the supply of money is that they cannot control the amount of money that households and corporations in banks put in banks on deposit, and they can't control the willingness of banks to create money by expanding credit, right? So even though interest rates have gone up, some banks, it doesn't affect really their lending or their ability to lend. They're still going to lend, as if the interest rates did not change before. So they can't always control the money supply, but they can do what is in their remit, right? So even there have been criticisms of, is it working as a policy to bring down inflation when most of our inflation is imported? Well, that is a debate by itself, right? So, but it just shows that there are limits to the power of monetary policy. But as the constituted monetary authority, they are have to do what is in with their remit to be able to bring prices down. So international trade and capital flows, talk about the balance of payments. Current account balance largely reflects trade in goods and services. The current account balance, we recorded a positive current account balance for the fiscal year 2022-2023. What that means is that our receipts of foreign exchange outweighed what we spent in foreign exchange. So we have a little surplus there. It mainly consists of capital transfers and net sales of non-produced, non-financial assets. From the investor standpoint, all of these things are important because you want to look at the movement of FX. If you have a current account balance, it means that your competitiveness is very high and it's certain in international markets. Not everybody can run a balance. They tend to run deficits, but all balances have to be balanced by deficits somewhere else in the world because it's international trade. Everybody is trading with each other. For Jamaica, you also have to look at the components of our entire balance of payments. So most of it, our receipts obviously come from selling services, which is tourism, as well as remittances, right? And we are a net importer, so we spend more on imports and we receive on exports. And then when you add up all of that, we have a very small surplus. Sometimes we run a small deficit. It's considered sustainable if it's in the range of maybe around 5% of GDP. But it is stable. It's always stable in Jamaican context, except for large, unpredictable events like COVID. You don't tend to find this, the current account deficit or the current account balance fluctuating too much. So when we talk about economic stability, that also influences economic decisions, investment decisions. You look at the financial account as well, net capital flows based on sales and purchases of financial assets. Those things also tend to weigh on the mind of investors. You look at, for example, FDI, the flows of FDI that come into the country. It has not been very high for a while, but it has been increasing since COVID. The highest, I think, was in 2008. I think it was at 1.4 billion US. Now it's somewhere in the order of 600 million US, but it's not the highest of our foreign exchange earners. And the investor might also tend to look at the transactions that happen on the capital account. So capital transfers and net sales of assets. You can have a Jamaican entity purchasing a foreign entity, and that pulls US dollars out of the system, and vice versa if a foreign entity purchases a Jamaican entity. So those large value transactions also have implications for the exchange rate, that the Bank of Jamaica has been trying to keep very stable, by occasionally pumping money into the market. So decisions by consumers, firms, and governments influence the balance of payments. Low savings, high investment tends to produce a current account deficit that must be financed by net capital imports. High private savings or low investment produce a current account surplus balanced by a net capital exports. So all else being same, a government deficit produces a current account deficit, and a government surplus leads to a current account surplus. So we have been running fiscal surpluses for 6 of the last 7 fiscal years, and that has created an environment where we are more likely to now record a current account surplus, because the tradition for years is that we run a double deficit. So a double deficit meaning a fiscal deficit and a current account deficit. And it's not ideal for you to continue to be in that situation. So because a sustained current account deficit contributes to a rise in the risk premium for financial assets. Current account surplus countries tend to enjoy lower risk than current account deficit countries. So, as I said earlier, it shows external competitiveness. If you can earn more FX than you spend, then that is always a good sign. And this has always been the case since around 1991, 1992, when we had liberalized the FX market in Jamaica. But at the time, it resulted, because the proper regulatory controls were not there, it resulted in massive inflation overnight to around 80%, and interest rates had to be raised to through the roof in order to bring them back down. So those are things that you think about. It's not something to worry about today, but that just shows the market dynamics of what decisions like fiscal policy and monetary policy, how they affect the macroeconomy. Capital restrictions are also controls placed on foreigners' ability to own domestic assets and/or domestic residents' ability to own foreign assets. In contrast to trade restrictions, they limit the openness of goods markets. Capital restrictions limit the openness of financial markets. Yes, so we have been speaking more about the free market, unfettered. There are no restrictions on price or quantity or anything. Sometimes you might need to have restrictions for whatever reason. I guess that will come in the market regulation segment. But from an investment perspective, it's important to understand the complex and dynamic nature of trading relationships, because they can help to identify potential profitable investment opportunities, as well as provide warning signals regarding when to disinvest in a market or industry. That part is always important, being able to see the sign down the road and forecasting what will happen. So in terms of exchange rates, the foreign exchange rate is by far the largest market in the world. It happens every day where you trade in currency. An increase in the exchange rate means the domestic currency is appreciating versus the foreign currency. Decrease means that domestic currency is depreciating. In a Jamaican context, that is something that is happening in both ways. You usually just see the currency just depreciating. Now it has remained relatively stable in the last 6 or 7 years compared to our experience before that. So we have two-way movement, and it's really a managed float. It's not completely free floating, where the demand for currency intersects with the supply for currency, and it determines the weighted average selling rate or the buying rate, because occasionally you have to pump some money into the market to satisfy the demand for FX. There are other, certain demands for FX that can carry the rate beyond what it is. If you demand more US dollars than JMD, then the rate will go up, and vice versa. The real exchange rate, defined as a nominal exchange rate multiplied by the ratio of price levels, measures relative purchasing power of currencies. So you have the real effective exchange rate, the nominal effective exchange rate. You have two different kinds of exchange rates in the market. You have spot rates for, as the name suggests, meaning right now, has to be settled immediately. Forward exchange rates are agreed upon for future dates. You want to hedge your risks, so you lock in a rate today for some future date to mitigate that foreign currency risk that will happen for depreciation. The spot exchange rate, the forward exchange rate, domestic and foreign interest rates must satisfy an arbitrage relationship that equates the investment return on two alternative but equivalent investments. Given the spot exchange rate and the foreign and domestic interest rates, the forward exchange rate has to take the value that prevents riskless arbitrage. Don't have much time left. Economic growth. As part of the development of the global portfolio equity and fixed income strategies, investors also have to determine the near-term and sustainable rates of growth in a country. As I discussed earlier, there's nothing on the horizon to suggest that Jamaica is going to exponentially grow over a very short period of time, because there's no change in the real structure of the economy that will facilitate or enable that. It's not like China, for example, that had developed a whole new manufacturing base where they could grow consistently at in excess of 6% per year for 40 odd years. But if that should happen, those are things that are going to inevitably affect your investment decisions and how you choose to invest your money. Right? You look at other places like Guyana, when they had their oil or natural resources. If Jamaica discovered natural resources, the game might change a little bit. So, but things like that, those are the kinds of developments in the markets, in the macroeconomy that happens that influences investment decisions. So, equity markets, for example, respond to anticipated growth in earnings. All of the stocks and shares that you see tend to be very sensitive to those sorts of movements. Higher sustainable economic growth should lead to higher earnings growth and equity market valuation ratios, all things being equal. That's another economic thing I had not previously gone into. All of these theories just assume that everything else is equal and nothing else sort of impinges on those decisions. So the best estimate for long-term growth in earnings for a given country is really the estimate of the growth rate in potential GDP, right? And if for very long your potential GDP is outweighing your actual output, your actual GDP, it means that you are underperforming, right? Relative to where you could be performing. And those also have a bearing on making investment decisions. It shows that there's not sufficient capacity utilization. You're underutilizing your resources. You could be better, but you're stuck. And so, that affects how you choose to invest as well. And that goes also to labor productivity. That's something we talk about in the Jamaican context for so long. Labor productivity has declined progressively for the last 40 years. We have not been able to break the back of it, but it does affect your potential output, right? And your earnings growth. So faster long run earnings growth and an increase in stock appreciation, they're all linked. The more educated, the more productive the population can be, the more they can produce, and that translates into higher expectations, higher earnings growth, higher stock prices, and so on. So for global fixed income investors, for example, the rate of inflation matters. One of the best indicators of short-term inflation is the difference between the growth rate of actual and potential GDP. As I mentioned earlier, capital deepening, an increase in the capital to labor ratio occurs when the growth rate of capital exceeds the growth rate of labor. And, Jamaica's markets aren't really that deep, but it's safe to assume that the rate of capital does grow more than the rate of labor, at least. Labor supply is determined by population growth, labor force participation rate, net immigration. We speak about every time the unemployment rate comes out, how many people are working in so and so industries. We're predominantly service based. We have all of these sectors that are predominantly service based. We see the kinds of value that they add, but when you have such a large labor force that is predominantly service based, that depends so much on your ability to train and upskill. And so if we don't do that fast enough, then we won't achieve the sort of GDP that we want, right? Market regulation is the last bit that I have. Knowledge of regulation is important. We see what happens when people flout the rules and they don't follow it to the T. Now we have things like the Twin Peaks model of regulation coming in, where we see that for financial institutions, prudential regulation will be handled by the central bank, and market conduct and consumer protection will be handled by another entity. So they help to reduce informational frictions, externalities, asymmetries. Those are all examples of things that are contribute to market failure. So, and we don't want that because it affects everybody. We have a special resolution regime is being developed to bail out financial institutions when they fail, and that the taxpayer does not have to do that. That should be borne by the entities themselves. You don't want to have privatized gains and socialized losses. Those are why market regulations are so important. We can speak about FinSac. We'll take another episode or two if we went into that. But the strength of regulation matters to investors. We want to know as well that your assets, your investments are also safe. So those are not things we can tend to ignore, whether on the micro level or the macro level, in terms of behaviors and mandates and so on. regulation of securities markets and financial institutions is extensive, it's complex, but it needs to be, because the consequences of failures in the financial system is so heavy. It just takes one firm. We talk about SSL, even though it was relatively small, the kind of impact that can have on loss of confidence, disrupting commerce, making people averse to investments. That's why prudential supervision, financial stability, market integrity, those are all very, very important for the investor to, take into consideration. Right. So that is my presentation. Jermaine.
Yes, I am back. That was great. I was just sitting there enjoying the just, I guess, connecting the different things that you're saying, as some things I never thought of in
Yeah.
that way.
I don't think I left
Yeah,
you
so
time for questions.
yeah, man, yeah, man. So we have a few. So let me take the one from IG first, so that we don't forget that one. So I believe this is from Kemil. Was asking, why did you say it's unrealistic to expect the economy to grow in the region of 5 to 6%?
So mostly because that would take a large structural transformation or some sort of mega project in an industry that is unprecedented. It's not something that's going to happen overnight. In order to facilitate that level of growth, you have to have the right sort of business environment, and that's not something that you change overnight. The perpetually high price of energy, you talk about levels of education, you talk about just the ease of doing business. These are all structural constraints that have been militating against us for years. So in order to grow at the level of 5 to 6%, whether over the course of a year or two or even 5 or 10 years, is going to require removing those impediments that have existed for well in excess of 40 years. And I won't say it's impossible, I might, but I would say it's very highly unlikely. It has to be something that can be facilitated relatively easily, and the pace at which we can absorb certain changes is not likely to facilitate that in a very short space of time.
So I'm agreeing with you 100%. I find it very frustrating um, to do business and to be in compliance in certain aspects of business. It simply takes too long. It takes long to open an account. It actually takes long to get a loan for your business. I think personal loans very easy to get right now. Like, it almost seems like an individual is seen as less risky to the bank than a business owner. Um, and so there are certain things that certainly are just, as you say, like impediments, because I tried to open a US company, and I was able to do everything online. I think I opened the business in a day. I filed the annual report recently, did that in about 20 minutes online. Everything was just easy. Opened a US bank account in like an hour. Like, those are things that for sure would help, to make it just easier to do business for sure.
Yeah, and the
Um,
things we agonize over, like just trying to find solutions to, are things that are not thought about in other advanced economies, right?
yeah,
Because it's the norm for things to operate efficiently, where it's probably the reverse in Jamaica.
yeah. I won't go down the rabbit hole for that one. So Orville is asking, are you a part of our Telegram group? If not, I could invite you to join, and so you can add some color or context when certain conversations arise. So we do from time to time, we'll maybe talk about things that relate to the economy, maybe interest rates, maybe some other topics. So
Mhm.
open invitation to you, sir, and for
Yeah,
anyone who's watching who wants to join.
yeah, definitely. I mean, I would definitely love to be a part of the community. So,
Okay. All right, Orville, you got that. Next one, he's asking, do you invest, and what's your investing style or strategy? And which sector or industry are you expecting or anticipate significant growth in the next 18 to 24 months? Sounds like a very targeted question.
Yeah, I mean that might be difficult to answer, but I don't really invest as much, at least not autonomously. I you know it takes a lot of effort that I wish I could do on my own, but I can't. I wish there's actually more for me to learn in the investment space. So I might know the wide parameters economically, but the nitty gritty, is something I can learn more from you, Jermaine, probably. So, I wouldn't say I'm an aggressive, active investor on that point. As for the sectors and industries, like I said, we are so staid when it comes on to sectors and industries, and that's why we need to update the industrial policy. It's almost 30 years old. It's from 1996. So some things that exist today didn't exist back then. And then there are other industries that we're just not pursuing. We don't have the energy really to pursue it. I can't say we're pursuing the blue economy or we're pursuing, cannabis had been mentioned for some while. There are so many other different color economies: silver, purple, orange, green, and so on, that we can be looking towards. We're always perpetually relying on manufacturing, agriculture, mining. Mining has accounted for most of our growth for the last couple of quarters. So it is just almost as concentrated as tourism. And that's, of course, the biggest one. Hope that related to our recovery as well as our decline during COVID, to show you how concentrated we are. So, it's difficult to say which industry, because they're always the same, right? For you to invest in. Yes, real estate and financial services probably tend to do consistently well, but most persons in the investing community probably already know that.
Okay, okay. All right, so the next question is asked by Orville again. So isn't isn't the BOJ there to hold the banks accountable? I think that's when we were talking about in terms of, I believe that was about monetary policy and the impact, or the BOJ's ability to impact what the bank does.
Right. So, I mean, that is in respect of monetary policy, talking about interest rates, but they can't, you know, force the banks to do something. They can persuade. It's always a process of moral suasion for the banks to say, okay, you need to raise your rates on deposits so that your depositors can get more money, kind of thing. But in terms of holding banks accountable, otherwise, it's just a thing that I have a personal opinion on. I don't think central banks really should be in the business so much of holding banks in line in terms of supervision. Their supervision prudentially is a function, but it should not be the main function. The main function is monetary policy, meaning interest rates, how that affects inflation, um, exchange rates, and so on. But in terms of prudential supervision, no, that is corollary to their main mandate, right? And you look at things like macroprudential supervision; those are that's separate from monetary policy. So you're not looking at capital and liquidity requirements and things like that. Bank supervision is more on the macroprudential side. You want to ensure simply that banks don't lose depositors' money, and that is important. Yes, definitely, but you shouldn't have to put a lot of effort into that. Banks must know that they must be responsible with people's money.
Okay. So, so Orville saying, well, that throwing a spoke in the wheel then. So I guess based on what you're saying. And then I think his final comment, I think it was more on the training side, was saying, the government and PSOJ should do more public-private partnerships to build out the infrastructure for these centers and workshops. Um, I mean, I think there's a lot being done by like the PSOJ, the JCC, the JMEA, the JBDC. I think the issue that I see with a lot of the things that are done, they're not doing them to scale. And that has always been my challenge. So You'll hear a workshop being done by the PSOJ because I Learn Grow Invest is a member. They'll send out an email, and maybe you go to that session. There are 20 people in the room. They have hundreds of members. I'll say to them, record record the session, make it available somewhere so that more members. Because if you miss the session in person, you won't get opportunity to get that training again until it's being offered again on the line. So I'm saying this not as a criticism to PSOJ, just in general. I think one of the ways we can just kind of get people learning faster is make things that scale, especially for the bodies that are meant to support infrastructure such as business and that kind of thing. We need more small businesses to get the basics right so that they can be more sustainable businesses so that we can tackle the larger problems instead of not knowing the basics, right? So JBDC, for example, does great workshops. They post them on YouTube, but now it's probably the awareness around it or the marketing around it. So there are definitely some gaps there, Orville, that I see, but those bodies, PSOJ, JBDC, JMEA, they do a lot already. Trust me, there's a session almost weekly with those places. It's just really the scale of it that may be the challenge. I don't know if the question was, well, it was more a comment than a question. Do you have anything to add to that?
Yeah, no, I absolutely agree with you. I don't think I could have put that more, eloquently. I think that is definitely the problem, the challenge of scale, right? And just think about the fact that Jamaica had record years, 2023, 2022, post-COVID, for registration of businesses, right? I think it was something like in the order of 5,000 something per year. So the entrepreneurial energy is there, but it's so hard to know, say, look, how many of these businesses can we tell you to do better in terms of your operations, just for some very simple suggestions. It's really hard to scale it up.
So Orville is asking if it could be political. I don't know, Orville. I don't know if we can answer that. What I see is that for some reason we are still a little bit fumbly. I don't know if that's even a word. Around technology, right? The things that relate to technology just seem to be an issue. Even something as simple as, so we do 99% of our content as live streams. I often have bandwidth issues, so much so that I have to have 2 internet providers. But it is said that our internet is better than most of the Caribbean. So in one sense, I'm like, why am I complaining when I have it better than some countries? And then at the same time, I feel like we've been doing it long enough where we should get it right. So I find where tech is just a challenge. Like there's sometimes people don't even know how to join a Zoom meeting when we've been using Zoom for almost 5 years now. So it's this, I guess, aversion to tech and technology that I think holds us back in a lot of regard. And I saw that when I worked with government, and I saw that in public sector. So maybe that's why some of the things that we need to automate in terms of doing business can't necessarily be automated, because a lot of it is probably still so manual. So I don't think it's politics. The specific thing we're talking about is probably just, yeah. So Paper Plate is asking, do you believe interest rate parity affecting Jamaica's economy in a negative way?
I don't think so. I mean, I can't imagine why. You know.
Yeah.
You know.
All right. Yes, Orwell, exactly. Adaptation is very slow. Very, very, very slow. So I do have a couple of questions for you from myself, just from the presentation. We'll try and get through a few of them. I won't make it too technical, but I want to kind of bring everything that you talked about together for somebody who maybe is trying to make sense of all of it.
Mm-hmm.
So you first thing you mentioned or you spoke about was supply and demand. So
Yeah.
how does that concept work or should work from the perspective of, well, should we take it the same as for the stock market, meaning that basic concept?
Yeah, I mean that especially applies to things like the stock market, real estate market. People's ability to trade as well, how much people can buy and sell in a single day. It's just really having to keep abreast of all of that, how that affects prices, how much people buy, how much people sell, at what price. That I think is really the building blocks of anybody looking to operate in the space can probably look at that and see why there were certain movements, what were the certain gains or losses? Is it attributable to this level of demand and supply, both individually and both in aggregate, even though the aggregate is really what matters most?
Okay. All right. So what should I be looking at, for example, as an investor? So you probably have, for example, a number of different reports or news sources that you may pull from as an economist. What
Mhm.
are some of the things that we should maybe start bookmarking, either reading, watching, or consuming to help us have some of that context to be able to make our investment decisions?
I think, well, I always go in the business section of the newspapers, Business Gleaner, Business Observer, and I, kind of just listen to business news religiously, both locally and internationally. You follow things like New York Times, Bloomberg. Anything that happens in the states obviously affects us. Anything the Fed does kind of affects us, you know, directly or indirectly. Otherwise, but yeah, listening to every time somebody in the business community speaks, it could be about anything. It doesn't even have to be about their own entity or their enterprise or base of operations. They could be talking about economy in general. And in an economy like Jamaica, where you have certain players are much bigger than others, that holds weight. Persons have more knowledge than others. It's all about information. If you want to be a better investor, you individually want to have more information, and you also want to reduce that asymmetry in the market. So it doesn't hurt to share information as well. Yes, I know people want to kind of, it's a market. It's supposed to be competitive where persons are trying to outdo somebody else, but better information, more timely information helps the market. Persons who invest in the stock market knows this. They're glued to every single AGM and annual report and quarterly report that comes out, where they can follow the numbers very intensely and scrutinize it very heavily as soon as it comes out. Timeliness of information also matters. So every time business news comes out, even on the news, TVJ, CVM, it helps, right? It helps to do that, even for persons. I used to say that for persons who do principles of business in high school for CSEC, you don't even need a POB textbook. You just need to follow the business news every single day, and people just get ones like that. Right? It's easy to follow because it's something that affects you day to day. The economy affects me, you, everybody, every man, woman, child in Jamaica that make up the population.
Yeah. And I mean, I've tried to open up my mind to understanding it, and I find that it has helped me. I did try to do an econ course once. I couldn't I couldn't make my way through it, but at the very least, I got some basics down, and it has truly helped me.
Yeah, I think the way we teach economics is so staid and professional. That we just see past the bigger picture. So, like for example, when the new currencies came out, persons were saying, "Oh, it's going to cause a drive in inflation." Yes, if you study economics in theory, then that might be the case. But which is why I never recommend people read an economics textbook to make investment decisions. You have to follow what happens in real life. So when if you're not wedded to economic theory, you would have probably known that when the currency came out, all it did was just redeem the old notes for the new notes. So you have just an increase in the, um, you know, the value of notes stays the same, but the volume of notes in circulation either stays the same or goes down because you're just replacing $1,000 with $2,000, and you're replacing $5,000 with another $5,000. So you can't just follow the textbook. The textbook is not going to account for peculiar circumstances in Jamaica's specific economic realm.
Yeah. So I wanted you to help us have an understanding of the market and economic cycles from the perspective that, so for example, when interest rates increase, as stock prices typically go down, we're seeing bond and preference share rates go up.
Yeah.
There is an expectation, though, that we may see lower rates by the end of the year.
Yeah.
You did mention that things can have a lagging effect, so it doesn't mean that if the rates go down that we'll necessarily feel the impact. But certainly from a securities perspective, what would that drop in interest rate, or what should it mean in terms of the theory, in terms of how the market should respond?
Yeah, I mean, I just think there's a lot of pent-up demand that's just waiting to be released. People have been waiting patient. It's been 3 years since the change in the monetary environment, and persons seem to be, of the opinion that we are past the worst, where inflation is concerned. People want to expand and borrow money. People want to have access to liquidity that just probably is out of reach right now. So they hope that the cost of capital will get cheaper. It's just like, that's when you talk about cycles, right? So, COVID had a lot of pent-up demand that was released very gradually. But then now with this change in the monetary environment, we had to pull back a little bit. And now I think the minute the signal is given, it has been given by the central bank governor. He did say that they are going to consider doing it, of course, in the very near future, within 6 months, which is why I said at the end of the year might be a good time. But when you start to see that being released, you're going to see the market dynamic changing a little bit. There are persons who have been delaying and patiently just trying to ride it out. We have seen the way people make investment decisions. When capital was cheaper, it's different from when capital is more expensive. And persons have been saying that we kind of see now who is caught up the creek without a paddle, because it's easier to make decisions when capital is cheaper than now, when you have to make decisions where the cost of capital is higher. But I think the demand is there, and it's going to be reflected when that monetary decision, as soon as you have any inkling of any change, then things are going to move in a certain direction.
So you're saying that the minute we see that announced, we should probably be preparing our portfolios for that change, because we've seen a lot of prices depressed. Company their stock prices that are at 3-year, 4-year lows, and a lot of companies. So back in 2018, 2019, a lot of companies were overvalued. Certainly now in 2024, a lot of companies are undervalued. So I think it's a great opportunity for us as investors. It's hard to buy when the price keeps going down, but it's really the best time to buy, because you're getting it at a more affordable rate than if the economy was better. And as you said, there's a lot of money. I think I saw maybe 57 billion in savings accounts early in the year. Like, that money is making nothing on it. So exactly. I think there are persons who are waiting to go back into the stock market, persons who are waiting to go back into investments, but they're waiting for that signal to say that interest rates are going to come back down.
There's no real soft underbelly in the economy, I think, where persons kind of had these premonitions that growth is going to go down as soon as you start to raise interest rates. But despite that, you realize that growth has remained stable. It has decelerated. Yes, that's what we expect. And, that affects things like revenues. It affected, even the taxes that were due on those income and so on. But the fact that you have not dipped into any sort of recession, right, it shows that there is some sort of underlying demand that is able to sustain a certain level of economic activity, right? So people, in other words, despite the high interest rates, people have not responded fully to say we're taking away our business activity, which can only mean that when you now ease up the monetary environment a little bit, persons will, you know, they'll have a little more leeway, right, to show that they have the potential and the capacity to actually now participate more fulsomely in the market.
I've always thought that was interesting because we've had recession-like conditions for 4 years,
Yeah.
and yet we have not announced a recession. Do you think that was intentional, meaning maybe the government didn't want to cause a panic? And I'm saying this for the US as well, because it's been just a very interesting time. And I wondered to myself if it's almost like, like when you experience symptoms, it's like you're sneezing, but you say you don't have a cold. You
Yeah.
just kind of go about your day, ignoring it until,
Well, I mean, broad numbers tend to hide a lot of things. And, even looking at the industries, yes, growth overall is this, but looking at industries individually, you're not finding that sort of decline or progressive decline. Yes, you might have 1 and 2 quarters where it might be negative and it's not, but it's not excessively negative, right? So, like, for example, construction. Um, Construction had been recording declines, but that is primarily because some road construction had been delayed, so it doesn't get counted in the figures. But building construction still continued. Yes, there's been a softening in the residential section of the market, but commercial seems to be picking up for that decline. Retail and office space, as well as warehousing, all a function of the increase in small business activity, which is driving that segment of the market. So things like that just show you that uh, persons have the demand, that it's there in different industries. It's able to sustain a certain level that can carry growth, however low it might be. But as I said, the important thing is that growth is stable and predictable. It's not about whether it can reach 5 or 6%. It's just, so you're basically humming along and you're churning along. You haven't really started to press the accelerator at any point.
Okay. So my final question, and I think we have one in the chat for you as well. So we spoke about that already. So what's your take on, for those who invest in the US markets, what's your take on what's happening over there? And is the investment decision any different than it would be in a local context, since so many things are similar in terms of how Jamaica responds in relation to what the US does?
No, I don't think it's that fundamentally different. I mean, of course, we take, what happens in the US, and the US seems to have sort of stabilized their situation with respect to inflation. We don't even have to, I think, wait on the US for them in terms of their monetary policy decisions. But I think it's pretty much the same across the board. You know, when you have your economic profile is sort of the same, very um, overwhelmingly tended towards things like services, for example, and services sustaining the lifeblood of your economy. I just think that you know the expansion can be greater. It's not as if you're trying to produce and manufacture goods, which kind of takes a little more time. But the economic profile overall, in terms of industrial sectors, it being what it is, I don't think the macroeconomy is going to be much different between Jamaica and the US. Jamaica can get ahead of the US, even when we did have our tightening of monetary policy. It was so aggressive and robust that we got ahead of the economy. So we don't have to wait on what happens over there, right? For us to do the same thing. For those who are investing in the US, like I said, I think the situation is going to be very, very similar.
Okay. And Paper Plate was asking, can you explain how the Fed fund rate in America affects the average Jamaican?
Well, I mean, it doesn't affect the average Jamaican. It kind of gets a little bit more before it starts to affect the average Jamaican. Fed funds rate in the US um, is only important in respect of our ability to manage inflation and keep our interest rate what it is. So if the Fed increases theirs, we tend to follow suit, and we try to keep that the differential um, in inflation and interest rates very low. Well, in the so that the rate of depreciation as well of the currency is not large, in terms of currency stability. So that also matters. So if we're talking about average Jamaican, we just want to be able to keep prices stable, low, and predictable. And that is a function of our level of interest rates, even though most of our inflation is imported. But I always respond to that by saying that, look, the Bank of Jamaica has to do what they have to do, right? If you think about inflation as consisting of something imported as well as something domestic, if you can control the domestic portion, then you should do everything you can to control the domestic portion, and it pulls down the average or pulls down the total, basically. So um, that is how the Fed fund rate in America is linked to what we are doing here and our efforts to mitigate inflation to get it back safely anchored into that level. Yes, it might go up a little bit because of burial and all of that, but if we have it sustained over a period of time, then we can say, okay, the efforts are starting to really bear fruit.
Okay. All right. So those are all my questions. Is there anything that maybe you want to add in closing based on everything that we've discussed?
Just to say that economics really is intuitive. You just have to watch what happens. The dynamics are so they change so quickly, so rapidly, and market developments, everything kind of has an impact, and you don't really see it. It's very latent that these things will tend to happen. But like I said, you can't just rely on theory. You have to watch what happens every single day. As and don't underestimate any sort of development. If it was something that, in the world of technocratic language, when we do our forecasting and what have you, the difference between 1.1% and 1.2% is very big, right? We have to get, is it 1.1 or 1.2? No, it's 1.2, not 1.1. That's very significant. So that's the kind of mindset that you have to think with, right? Don't underestimate anything. Everything matters for a reason, any single development, and it's about engaging the way you think, right? It's not about relying on economic theory and what happens, because we're not always rational actors in a perfect world, ceteris paribus, everywhere, all things are equal. So it's about following trends, discerning patterns, and being able to establish meaning and underlying what underlies those trends. And I think once you are thinking in that sort of mindset, then you're well on your way to really making investment decisions in an economic way.
All right. Thank you so much, Keenan. I learned so much from you. I'm happy that we're able to do this and that this video is here. So I'll be certainly pointing our community members to this because I think it'll lay a good foundation for them, help to explain certain things and make them less afraid of all the information they'll see and hear on the news, and gives them an opportunity to understand it. So thank you so much, and we should probably have a follow-up conversation,
Mhm.
maybe targeting very specific topics now.
Yeah.
And so I'll keep you posted on that. So thank you so much.
Yeah, and thank you so much, and thanks to everybody in the community as well for listening. I really, really appreciated it.
Yeah, man. And I'll share the link with you to join so that you can be a part of our group as well.
Yeah, man, definitely.
All right, guys, thank you so much for being here. Yes, Orville, 10% of 20 million is not the same of 10 as 10. Oh, well, sorry. 10% of 20 million is 2 million. That's 10% of two. Okay, I just got what you're saying. I was like, isn't that the same thing? Okay, I get your point. Guys, this was great for me. Hopefully, it was for you as well. If you don't get it the first time, that's okay. Watch the video again. Take it in slow. You can watch it in stages. That's completely fine. When I was first learning this, it took me some time to just understand even some of the words that were being said. But that's why we do our content on YouTube. That's why it's here for you to watch at your own pace. The slides were there for you to be able to make notes, pause the video, make notes. And you'll notice if you watch our Stocks to Watch series, which I encourage everybody to watch, because that's a series that helps you as an investor to make investment decisions. You see that we're always looking at something relating to the economy, whether interest rates, whether how a certain sector is performing. And so this piece, this information that we just learned is important to factor into our investment decisions. So it's not something that's abstract, it's very practical. And so I'm happy that we're able to do this. So just a few things. Yes, Orville, I'm happy that you said that. That's what we want to go back to, right? We used to do these weekly topics that were new, that taught you a lot. I want to get back to more of that, right? So it's a few things. Call to join our community. If you're not in our Telegram group, you should be. I'm going to share the link to our Telegram group right now. Let me just get that link here. So I'm going to put it in the chat. It's also in the description of this video. And so we welcome you to join our group. We have quite a number of persons in there. We talk every day about different things and different topics. It's a safe space. Nobody will bully or anything like that. And it's just, feel free to ask questions and you learn a lot. Next is our conference. It's 3 months away. Grow Your Wealth Conference. It's for entrepreneurs and investors. That's who it's targeted to mainly. So it's for our community, right? A lot of persons in our community are entrepreneurs. A lot of persons are investors. So we're gonna have topics to help you both. You're gonna see more marketing for it in a couple of days. You'll see who some of the speakers are. We just finalized our keynote speakers. We're very excited to share that when it comes out. We've been doing a replay of some of the videos from last year, some of the speakers from last year. So you would have seen that video recently. We did the fireside chat with Kadeen Mears just Sunday gone. We did a video with Mariam a few months ago. So you'll get some of the content, not all of it, some of it, because there's still value in purchasing the conference, which you can do on our academy. But we certainly want you to get tickets. Just a little bit over 200 spaces. I don't know, 200 may sound like a lot now. Or a little bit over 300 spaces, that may sound like a lot. But we have a community of over 10,000 people. So you really want to get your tickets as soon as they're available and join us for those 2 days. It will be awesome. All right, and let me see if there are any more questions here. Let me check IG. All right. Okay, so final call for questions. But guys, I've been seeing a lot of reports come out. I'm wondering if I should do like an earnings breakdown or something. I'm going through some of these reports and it's very interesting to me. I may have to do an earnings review to cover some of these. So let me know in the comments, not the chat. Let me know in the comments which companies you'd want me to review, maybe for the next Market Money. Though we will have a guest next week. I can't say who it is yet, but we'll have a guest. And we do have a CEO series to release. But Orville, I don't know what type of links you think I have, but I'll try. Let me put it that way. I'll send an email to his team and see if they respond. But I actually emailed a very well-known speaker in the personal finance space just this week. I was like, they're not going to respond. the person responded directly, and we're talking, and they may potentially join us for the conference. We'll see, but we do have some international speakers coming down for our conference already. Just yeah, we're trying. we're trying. Roger, place it in the comments below, please, because the chat, I'm not going to be able to see it in its entirety after the live ends. So be sure to post it in the comments. All right, everyone, thank you so much for watching. Thank you for joining us for another episode of Market Money. I'll see you in the very next one.